Hello everyone. Hello everyone. Welcome to live virtual revision classes from the Board of Studies. I am Kriti
Recording in
Chawla.
progress.
Hello everyone. Welcome to live virtual revisionary classes from the Board of Studies. I am Kriti Chawla and today we will be talking on the topic transfer pricing and advance ruling. This topic is part of paper 4, which is direct tax laws and international taxation. So as far as this particular presentation is concerned, we will be concentrating on two major topics right here. It's going to be transfer pricing and then advance ruling. Now, as far as transfer pricing is concerned, we shall be starting with an overview of transfer pricing. Now, I understand that this is a revisionary lecture, but still we will be talking about, what was the need to have transfer pricing. We'll discuss the problem with the help of a case study, and then we'll tell you about, what is the rule that has been introduced to make sure that those tax avoidance strategies do not happen. That is where transfer pricing law came in, and that is what we will be talking about. Our primary focus will be obviously, the manual that has been shared, but also the Indian transfer pricing regulations. And looking at those particular regulations, we will be talking about the definition of associated enterprises and the definition of international transactions. Now, when we talk about associated enterprises, this is where the law talks about these 13 instances through which two enterprises can be deemed to be associated enterprises. That is what we will be concentrating upon. And finally, we will be talking about the definition of international transactions. And within that, we will also talk about the concept of deemed international transactions. After that, we will be talking about the 6 transfer pricing methods that have been provided. By now, I'm sure you know about, all these methods. It's CUP, TNMM, RPM, CPM, PSM, and other method. We will be talking about these particular methods in a lot of, detail. And then we will also be talking about a few examples to understand where what method is actually suitable. After that, we will be talking about transfer pricing documentation. Within transfer pricing documentation, we'll be talking about Form 3CEB, which is also called as Accountant's Report. And at the same time, we will be talking about the TP study, which is coming from Section 92D. Now, this is where all through this particular presentation, I will be talking about sections also. So just keep those particular sections in mind. Section 92D that talks about transfer pricing documentation. After that, we will be talking about the three-tier documentation structure that has been brought in by OECD BEPS Action Plan 13. Now, BEPS Action Plan 13 has been incorporated in the Indian Income Tax Act through Section 286. That is what we will be talking about. After that, we will be talking about, safe harbor rules. Then we'll talk about something called as APA, which is Advanced Pricing Agreements. And within all these things, these are more like, dispute resolution mechanism. We'll also be talking about primary adjustment. Followed by that, we will be talking about something called as secondary adjustment in transfer pricing. After we are done with all these concepts, the last concept that we will be concentrating upon is Section 94B, which is limitation of interest deduction rules. So that is what we will be concentrating on. This entire thing is going to be transfer pricing for us. So what I've done is I've picked up, most of the concepts actually, which are provided in the manual, and I've tried to, help you revise through all those, concepts. What I've done additionally is that through the entire presentation, you will be finding, questions and examples through this particular, slide deck. So we will be doing those particular questions and those particular examples to help you understand that very concept in a detailed, manner. After we're done with transfer pricing, the last topic that we have for today is going to be advance ruling. And like I said, within advance ruling also, I have provided examples there. These examples and these questions are from past papers also. So we will be discussing, those as well. So yes, without any further delay, let's just get started with these particular topics. So the first topic that we have in mind is transfer pricing. Before we actually get started, I just wanted to tell you that, if you look at transactions all around the world, about 30% of the transactions they happen within multinational enterprises. These are called as intra-group transactions. I'm sure you know this term by now because this is widely used, in transfer pricing. So this particular term is called as intra-group transactions, transactions that happen within the group itself, within the multinational group itself. Now, these transactions could be maybe a transaction between, with a parent company and the subsidiary company, or transactions between two subsidiary companies, etc. But the problem is there's always like a problem with these kind of transactions. Now, my question is, what is, this problem? Well, uh, the problem with these kind of transactions is provided in this particular slide. The problem is that, when you have transactions with unrelated parties or, independent parties, those particular transactions are always driven by market forces. What do I mean by market forces? Well, the thing is that there is always, a mechanism of demand and supply that operates. As in, whenever, a transaction between independent parties happen or unrelated parties happen, they're always conducted at open market price. As in, the seller would always want to sell at the maximum price possible, and the buyer would always want to purchase something at the minimum price possible. And this is the reason through this particular negotiation, they come up to something called as the open market price. So that is about, unrelated parties. But the problem is that, when related parties or when associated enterprises, when they transact between themselves, these group driven factors are little different. Sorry, these market driven factors are a little different. They do not really transact at an open market price, but they transact at a price which is, governed by the relationship that exists between them. They transact at a price which differs from open market conditions, which is operating between independent parties. So the price for, related party transaction or the price for associated enterprises, it is driven by, like group driven factors and market driven factors. And this is the reason there could be a manipulation of these particular prices, because they're no longer driven entirely by market forces, but they're driven by, like their common interest of the entities, of the group. And so what they do is they manipulate this transfer price. And why do they manipulate this particular transfer price? Well, to reduce their tax liability. And that is not reflective of economic reality of a transaction. And that is where something called as tax avoidance really happens. And this is the problem that was occurring in related party transactions. We'll discuss this using, two examples right here. But this is what I want to, just as a revisionary, topic, this is what I wanted to actually focus on. Whenever, there is manipulation of transfer prices, there exists something called as tax avoidance. Now, at this stage, you should know the difference between tax avoidance and tax evasion. Well, when it comes to tax evasion, that is where it is, illegal. Tax evasion is punishable under the Act. If an entity or if an enterprise indulges in tax evasion and they're trying to minimize their tax liability, they are, there's fine that is imposed, or there is penalty under the Act, or there could be imprisonment also in certain cases. However, tax avoidance is something which is again minimizing the tax liability, but doing that in a manner which is sort of legit. It is a crime against the society, no doubt, but it is not necessarily punishable under the Act. And to make sure that those tax avoidance strategies do not happen, this is the reason they've come up with something called as transfer pricing. So coming back to what was, the problem with intra-group transactions, what was the problem with those associated, party transactions? Well, this is the problem that we'll be discussing through this particular case study. Now let's look at situation one on the left side of the screen. Now, when you look at situation one talks about a transaction between independent parties. Let's look at this particular transaction where we have a company in India, and let's say that this company is a manufacturer in India. Now, this particular company is manufacturing pens and it's selling pens to an overseas company. So let's say that the cost of manufacturing these particular pens is 60 rupees. They decide, because these two companies are not related to each other, they're just a company in India and then there is an overseas company here. They decide that we're going to be selling the pens to another entity at 120 rupees. Where is this 120 rupees coming from? Well, this is called as the open market price. This is the price that is in the market, and this is the price that is coming from, as I mentioned here, the mechanics of demand and supply. So this is the reason we have 120 rupees. So they sell at 120 rupees. The cost of manufacturing the pen was 60 rupees. So the profit that they have now is 60 rupees right here. Now tax is at the rate of 30%. So tax becomes 18 rupees. Tax at the rate of 30% on 60 rupees becomes 18 rupees. So in this particular situation, the tax that they have to pay for the company in India is going to be 18 rupees. Now let's look at the same situation. Everything remains the same. The only difference is that now these two entities are related to each other. So now this is the parent company and it has an overseas subsidiary, meaning to say that now the transaction is between a parent company and a subsidiary company. Now, the cost of manufacturing again is 60 rupees. The parent company is manufacturing. And as I mentioned, everything remains the same. So they are manufacturing and they are manufacturing pens. So the cost of manufacturing that particular pen remains the same at 60 rupees. Why does the cost not change? Well, the cost does not change here because this is a third party cost, because no third party would like to change their cost. This is the reason it remains the same at 60 rupees. The only difference right here is that they are not selling at 120 rupees now, they will sell at 80 rupees now. Why are they selling at 80 rupees? Well, where have they come from to 80 rupees from? Well, 80 rupees is something like group driven factors and market driven factors. It's a combination of both. I'm not saying that 80 rupees is the open market price. We do not know that, but 80 rupees is a price at which they transact. The related parties, they like to transact with each other. It's just a price which has been derived because of the relationship that exists between these two related parties. So they decide that we'll transact at some random price at 80 rupees. So the sales happen at 80 rupees. Cost is at the rate of 60 rupees. So profit comes down to 20 rupees. Now tax again at the rate of 30% on 20 rupees becomes 6 rupees right here. So do you see how, because they were able to manipulate this particular transfer price of 80 rupees rather than 120 rupees, they were able to bring the tax down to 6 rupees from the erstwhile 18 rupees. And this, as I mentioned, is something called as a tax avoidance strategy. How did this tax avoidance strategy happen? Well, this tax avoidance strategy happened because they were able to manipulate their transfer price from 120 rupees to 80 rupees. So there is a possibility that two or more multinational companies, if they're belonging to the same multinational group, they can fix up their prices of goods and services, and they can allocate profits among the enterprise within the group in such a way that either there is no profit or there is negligible profit in that particular jurisdiction. And this is the reason there is tax liability that is going to be minimum out here. Now this really is the problem with related party transaction, how they were able to bring their tax liability down from 18 rupees to 6 rupees. This is really the problem that we are talking about. Now, is let's look at this particular, this is where this is one of the case studies where we've looked at the problem from one side. We've just looked at the problem from the Indian aspect, the tax aspect, right here. Now let's look at the this particular case studies from two angles, from this angle and from the other angle itself. So this is another case study where we'll be talking about the problem from two-sided perspective. Now, uh, in this particular case study, we have, let's say, company F. Company F is a company in India. It's incorporated in India, and the tax rate in India is 30%. Now, there is another company out there, which is company I. Company I is incorporated in Singapore, and the tax rate in Singapore is 17%. And then there is a third party customer. So, how the transaction really flows is that company F manufactures a particular commodity in India, then it sells the commodity to company I in Singapore, and then company I sells the commodity to third party customer. So what company F manufacturer is doing is that it is selling its commodity to third party customers through a company in Singapore, and the tax rate in Singapore is 17%. So let's see how the transaction actually flows. Now, for the purposes of this particular case study, let's look at the black font first. So we'll be concentrating on everything which is written in black, right here. So company F manufactures the commodity at $1,200, which is just provided here, this one. So it manufactures the commodity at $1,200. Now it has to sell the commodity to company in I in Singapore. And at this stage, we're looking at the black font. Black font basically means that company F and company I are independent parties. They are not related to each other. So company F decides to sell the commodity to company I, and they're not related to each other, and they decide to sell it at $1,400. So if you look at it from the Indian company's perspective, selling price is $1,400, cost is $1,200. So the profit that they have is $200 in India. So I've provided it here in India. This table, if you see in India, the profit is $200, and the tax in India is at the rate of 30%. It's provided here. So tax on $200 at the rate of 30% makes it $60. So this is $60, the tax that they have to pay in India. Now, what happens is that this particular, the selling price for the company F becomes the cost price for company I, because company I has purchased that commodity from company F. So $1,400 becomes, the purchase of goods right here. Then company I, they decide to put in some costs, some advertisement costs, some, marketing costs, etc. And the cost for selling the commodity to the third party customer is $100. Now, company I decides to sell the commodity to the third party customer at $1,600. So let's look at the profit in Singapore. It's going to be 1,600 less 1,400 less $100, and the profit in Singapore is $100. So I've provided it in the table right here, $100 of profit in Singapore. The tax rate in Singapore is 17%. So 17 is, right here. So if you look at the tax that the group has been paying on a whole, it's going to be $77. How? $60 of tax that they've paid in India, and $17 of tax that they have paid in Singapore. So it becomes $77 of total tax that they are actually paying. Not as a group, because these two entities are not related to each other. So this is the $77 of tax that they are actually paying. Now, let's reverse the situation. Now, let's say that these two entities are related to each other. Let's say that company F is, the parent entity, and company I is, let's say, a subsidiary company. So now they are related to each other. As I mentioned, let's look at the Indian aspect first. The cost of manufacturing the commodity is $1,200. This will not change because, as I mentioned, this is a third party cost. Now, the sale of goods, instead of selling the goods at $1,400, because these two entities are related to each other, they decide to sell the commodity at $1,300. Why $1,300? Well, that is because this is a price that has been achieved because of the relationship that exists between company F and company I. It has nothing to do with the open market price. It is everything to do with the relationship that exists between company F and company I. So it's going to be $1,300 of selling the goods right here. The cost is $1,200. So if you look at the profit from company F's perspective in India, it's going to be $100. How? 1,300 less to 1,200 becomes $100 right here. So I've provided it here. Look at the red font now. The red font means that the two companies are related to each other. So $100 of profit in India. The tax rate in India is 30%, so it's going to be $30 of tax in India. Now, this particular commodity goes to company I in Singapore. They purchase the commodity at $1,300. The cost again is $100 in advertisement, marketing, etc. And the sale of goods now happen at $1,600. Why $1,600? Because this is a third party cost. This will never change irrespective of the fact whether company F and company I are related to each other or they're not related to each other. This will not change at all. So 1,600 less 1,300 less 100, the profit in Singapore is $200. So $200 of profit in Singapore. The tax rate in Singapore being 17%, so it's going to be $34 of tax in Singapore. So if you look at it from the perspective of the group, the total tax that the group has now to pay is going to be $64. How $64? $30 of tax in India and $34 of tax in Singapore. It becomes $64. So if you look at it, from a whole perspective, because these entities got related to each other, because these entities now became associated to each other, they are now paying a tax of $64 instead of $77. So there has been a group tax saving of $13, 77 less 64. And how did this group tax saving happen? It happened because they manipulated the transfer price. They did not transact at an open market price. They transacted at a price which was driven by their market, driven by their group forces, which is $1,300. That's how they came up to this particular price. And because of that there was a group tax savings. So it is where this kind of pricing, it does not accord with applicable internationally or domestic laws. This is where we enter the area of something called as mispricing. This is incorrect pricing. This is unjustified pricing. And this is where tax avoidance actually arises. Now, this is also a classic example of something called as base erosion and profit shifting. Shifting the profits from, a high tax jurisdiction like India of 30% to a low tax jurisdiction like Singapore, which is 17%. So this is really the problem that was happening in related party transactions. And there was something that was to be done to make sure that these tax avoidance strategies do not happen. This is the reason they came up with something called as transfer pricing. Now, if you look at transfer pricing is basically an anti-tax avoidance law. Transfer pricing provisions or transfer pricing regulations were introduced to counter such transfer of profits, to make sure that these transfer of profits do not happen. This is where they came up with a law, and this particular law will now prescribe at what price should transactions between related parties happen. Should they happen at 80 rupees, this related party transactions? Should they happen at 120 rupees? Should they happen at 200 rupees? Should they happen at like 60 rupees? What is the price at which these related party transactions should happen? That is basically the law which is called as transfer pricing. So this is where I've mentioned, the definition right here. Transfer pricing is the general term for the pricing of cross-border intra-firm transactions between related parties. So it has to be a cross-border transaction, it has to be an intra-firm transaction, and it has to be between related parties. If it is not between related parties, obviously, there will be no tendency, there should not be a tendency of, price manipulation, but it is only when it happens between related parties or associated parties that there is a tendency to have a tax avoidance strategy in place. So transfer pricing, it refers to the setting of prices at which transactions occur involving the transfer of property or services between associated enterprises forming part of a multinational enterprise group. So this is basically, the law. So the point is, at what price should these transactions happen? Should they happen at 80? Should they happen at 120? At what price should they happen? Well, these transactions should happen at something called as the arm's length price. What is this arm's length price? Well, this arm's length price is the price at which transactions between related parties also should happen. So what is this arm's length price? Well, very simply put, arm's length price basically is a price uh, between independent parties in comparable situations. So what you have to do is look at the transaction between independent parties. Is this transaction between independent parties comparable? It is comparable on the basis of those 5 comparability factors. So are these transactions, comparable? If yes, well, then that independent party price should be something called as the arm's length price. So this is where I've mentioned arm's length price means a price which is applied or it is proposed to be applied in a transaction between persons other than associated enterprises in uncontrolled conditions. That is uncontrolled transactions. When I say uncontrolled transactions, it's basically independent party transaction, and it should be in comparable situations. So this is where situation 1, which is between independent parties, it is mentioned as uncontrolled transaction, and situation 2, related parties, it is mentioned as controlled transaction right here. So this is what is mentioned as arm's length price. Arm's length price of a transaction between 2 associated enterprises is the price that would be paid if the transaction had taken place between 2 comparable, independent and unrelated parties. So that is basically, the arm's length price. Now the point is, where is this arm's length price coming in from? Well, the arm's length price is coming in from the arm's length principle. The arm's length principle is the international consensus on transfer pricing, meaning to say that, if there are jurisdictions around the world that are following transfer pricing, they will also use something called as the arm's length principle. So it's like the standard which is used in transfer pricing, and it will ensure that if there are transactions between related parties, they should be conducted in the same way that transactions are conducted between unrelated parties, just like at market value. Now, this is the principle that will help to prevent tax avoidance by ensuring that profits are not artificially shifted between related parties to take advantage of different tax rates in different jurisdictions. So this is what is mentioned, which is called as the arm's length principle. Now we'll go on to the next topic, which is called as, the Indian transfer pricing framework. What is the domestic law framework, as in the structure of transfer pricing provisions, in India? Now, you should know the year when transfer pricing was introduced in India. This was the year 2001. Now, this was the Finance Act of 2001. This actually recognized that international transactions between related parties, they were not subject to the same market forces as transactions between independent parties. Like I mentioned, we just saw that, transactions between related parties, they were happening at the group driven forces was in place, and they were happening at another price altogether, not at open market price. So they were not subject to the same market forces. This is the reason the Finance Act of 2001, they introduced Chapter 10. Now, Chapter 10 is special provisions relating to avoidance of tax. This is called as Chapter 10. It is Chapter 10 of the Income Tax Act 1961, and this was added to just regulate transactions between associated enterprises. This was applicable with effect from 1st April 2002. Now, this chapter includes sections 92 to 92F, and there is also rules that you should look at, Rule 10A to 10E of the income tax rules. So this is Chapter 10 of the Income Tax Act 1961. There is Section 92. Section 92 says computation of income from an international transaction having regard to the arm's length price. Then there is Section 92A, which is the meaning of associated enterprises. Then there is Section 92B, which talks about the meaning of international transactions. Then there is Section 92BA that talks about specified domestic transactions. Section 92C, this has to be read with Rule 10B and 10C, which talks about the arm's length price. Section 92D and 92E talks about documentation and the accountant's report under the Income Tax Act. And finally, there is Section 92F. It talks about the definition of certain terms which are relevant for computation of the arm's length price. Now, all these terms will be explained in detail going forward, and that is, how we'll be conducting this particular, presentation today. As far as the rules are concerned, these are the relevant rules under the income tax rules of 1962, which are pertaining to transfer pricing. Rule 10B, it talks about the determination of arm's length price under Section 92C. Rule 10C talks about the most appropriate method, the transfer pricing method. Rule 10D is information and documents to be kept and maintained under Section 92D. And Rule 10E talks about report from an accountant to be furnished under Section 92E. So these are the rules that we will also be discussing, today. So we'll start with the first section altogether, which is going to be Section 92 of the Income Tax Act 1961. Now, Section 92 says that if there is any income which is arising from an international transaction, it shall be computed having regard to the arm's length price. So what I'm really trying to say is that even in India, the transfer pricing provisions take care of something called as the arm's length price. They operate using something called as the arm's length principle. So, the objective of transfer pricing provisions in India, or generally, it is to protect the tax base of India and ensure that due to intercompany transactions, there is no reduction in taxable profits or, the taxes which are paid by the Indian taxpayer. So, transfer pricing provisions would not be applicable if the substitution of ALP, or if by using the ALP it has the effect of reducing the income chargeable to tax or increasing the loss. So if the income is reducing or the loss is increasing, then transfer pricing provisions will not be applicable, going forward. So this is the arm's length principle of Section 92. Now, this was, the overview of transfer pricing provisions in India. The next topic that we have for today is basically associated enterprises. After this, we will be discussing deemed international transaction. Then, the methods is what we will be discussing. And finally, we'll go into safe harbor rules. So, yes. We'll talk about the first thing, which is associated enterprises. Now, associated enterprises is coming from Section 92A of the Income Tax Act 1961. This is Section 92A, subsection 1 of the Income Tax Act 1961. And then there is Section 92A, subsection 2 of the Income Tax Act 1961. So there is like a general definition under Section 92A1. The general definition says that, there is a relationship, there is like participation. And this participation by one enterprise in the management, control, or capital of the other enterprise, this will result in two enterprises being associated enterprises. Or, if there is same person which is participating in the management, control, and capital of two enterprises. So if there are two enterprises and they participate through capital, or they participate in management, or they participate through control in, the other enterprises, then the two enterprises will become associated to each other. Apart from these, also any relationship of mutual interest as may be prescribed shall also be considered as associated enterprises. So let's look at this concept using this particular example. Let's say that there is company A. Company A is participating directly or indirectly in the management, control, or capital of another enterprise. Let's say company B. Well, then company A and company B will become associated to each other. Let's say that company A, through an intermediary, is participating in the management, control, and capital of company B. Well, then company A and company B will also be associated to each other. Well, if there is same person, and through the same person, they are participating in the management, control, and capital of company one, and this same person is participating in the management, control, and capital of company two, well, then also company one and company two will become associated to each other. So this is, the generic definition of section 92A subsection 1, participation in the management, control, and capital of the other company, then they will become associated to each other. Now, after this particular thing, after the generic definition, there is specific instances that are provided there. There are section 92A subsection 2 of the Income Tax Act 1961. And this one says that for the purposes of subsection 1 is this subsection. So for the purposes of subsection 1, two enterprises shall be deemed to be associated enterprises if at any time during the previous year, these 13 instances are actually met. So these 13 instances, if these particular instances are met, then two enterprises will become deemed to be associated enterprises. So now going forward, these are, the 13 specific relationships that, we will be discussing, going forward. So yeah, what I've done is, I have divided these 13 instances into three different parts. These three different parts are capital, management, and control. Some of them are capital oriented, some of them are management oriented, and some of them are control oriented. But I'd just like to mention that law does not do that. Law has not divided them into these three categories. It's just for ease, it's just to, remember these instances that this has been divided, but otherwise in law these 13 instances, they just appear as it is. So let's look at the first instance, which is section 92A, subsection 2, clause A. It says two enterprises shall be deemed to be associated enterprises if at any time during the previous year, section 92A, subsection 2, clause A say direct or indirect holding of shares carrying 26% or more voting power. So what they're really trying to say is that if one entity holds directly or indirectly 26% share capital in another enterprise, then these two entities will be associated to each other. Now, a lot of things that you have to keep in mind, right here. The first thing is 26% or more voting power. So, at 26%, or more, 27%, 28% going forward, they will be associated to each other. Then what they're actually talking about is voting power. So what we're looking at here is equity share capital and not preference share capital. So this is and what you have to remember is that there could be direct holding or there could be indirect holding of shares right here. So as an example, let's look at this particular example, right here. Take a minute and, just look at this particular example right here. And read through this example, then we'll discuss it. Okay, so looking at this particular example, it talks about A, which holds 33% of voting power in B Limited, and B Limited holds 80% or 80% voting power in C Limited. Now, because A Limited holds direct participation in B Limited, 33%, A Limited holds 26% or more voting power in B Limited directly. This is the reason A is associated to B. And B is associated to C, and because B is associated to C, this is the reason C will also be associated to A Limited through an indirect participation. So A is associated to B is associated to C. This is the reason A, through this particular intermediary, which is B Limited, it's called indirect participation, it will be associated to C Limited. So that is what indirect participation really talks about. Now, Section 92A, subsection 2, clause B, talks about voting power by same person in each enterprise. As I mentioned here, we'll discuss an example. So it talks about direct or indirect holding of shares carrying 26% or more voting power by the same person in each enterprise. So this is one of the examples right here. Let's say that there is Mr. A. Mr. A holds 40% voting power in X Limited, and they hold 40% voting power in Y Limited. Now, because this is a same person, Mr. A will be associated to X Limited because they hold more than 26% voting power. They will be associated to Y Limited because they're holding again more than 26% voting power. It's 40%. So this is the reason, because there is a same person right here, Mr. A. This is the reason X Limited and Y Limited will also be deemed associated enterprise because they have a same person, Mr. A, right here. So this is coming from section 92A, subsection 2, clause B. Now there is section 92A, subsection 2, clause C, which talks about provision of loan not less than 51% of book value of total asset. Now, if one entity provides loan to another entity, and this loan is 51% or more of the book value of total asset, then two entities will become associated to each other. So what they're actually looking at, the book value of, the total assets. Then there is section 92A, subsection 2, clause D, which talks about guarantees not less than 10% of total borrowing. So if there is a guarantee which is, provided, maybe, there is, debt which is to be taken. Uh, um, So if there is debt which is, taken, and this is, there is a guarantee which is provided there, and the guarantee is 10% or more of the total borrowings, well, then two entities which has provided guarantee and which has, on whose behalf guarantee is provided, they will be associated with to, each other. Now, this particular guarantee transaction, you have to remember, this has to be in pursuance of borrowing. It cannot be in terms of any other kind of guarantee from associated enterprise. It has to be guarantee in pursuance of borrowing. Now, the next set of conditions or the next set of instances that are provided here are management instances. So for this, we have section 92A, subsection 2, clause E and clause F. Now, clause E and clause F, they talk about appointment. Now, if there is one entity and more than half of the board of directors or the governing board of or one or more of the executive directors or executive members are appointed by the other enterprise, then the two entities will become associated to each other. So one entity and there is another entity, it has a board of directors. If you appoint more than half of the board of directors, then these two entities will become associated to each other. Or even if you appoint one executive director or more than one executive director, then also, or executive member, then also they will become associated to each other. It could also be the same person in both the enterprises. That can also cause association right here. So if there is, we're not talking about remuneration committees or audit committees right here. Those are not included. But otherwise, all other governing boards or board of directors, that is actually included. Another thing that you have to remember is that they're talking about executive directors. So independent directors, these are not non-executive directors. They help the company in improving corporate credibility and the governance standards. So those are not included, but otherwise executive directors and executive members are actually included. So we have, some examples right here to look at association. Let's say X Limited, it has 15 directors on its board. Out of that, Y Limited has appointed 8 directors. In such case, X and Y are deemed associated enterprises because half is 50% is 7.5 and they've appointed more than half, which is 8 directors. So they will be associated to each other. Mr. A appointed 9 directors out of 15 directors of X Limited and appointed 2 executive directors on the board of Y Limited. In such case, because this is a common person, Mr. A, they have appointed more than half of the directors in X Limited and they have appointed 2 directors, executive directors in Y Limited. This is the reason both X and Y Limited, they are deemed associated enterprises because there was one common person that has appointed in X and they have appointed in Y also. So they will be associated to each other. Just take a minute and look at these two examples and we can discuss it further. I'll give you 30 seconds. Just look at, these two examples again. Okay, now we look at the next set of conditions right here, which are control conditions. So now we'll look at, the first one, which is clause G, which talks about complete dependence on intangibles for manufacturing, processing, or for business. Now, this is where, I've mentioned the law right here. It says the manufacture or processing of goods or articles or business carried out by one enterprise is wholly dependent on the use of know-how, patents, copyrights, trademarks, licenses, franchises, or any other business or commercial rights of similar nature, or any data documentation, drawing, or specification relating to any patent, invention, model, design, secret formula, or process of which the other enterprise is the owner, in respect of which the other enterprise has exclusive rights. So if one entity is dependent completely 100% on intangibles for their manufacturing, then two enterprises will be associated to each other. But for this, what you have to remember is that the other enterprise has exclusivity, is the owner, or they have exclusive rights on that particular intangible. Then there is 92A to H, which talks about supply of raw materials, 90% or more, and the prices and other conditions relating to the supply are influenced by such other enterprise. Now, this is where if raw materials are supplied 90% or more, and the prices or other conditions are influenced by the other enterprise, well, then two enterprises will become associated to each other. Or I, which talks about goods manufactured or processed by one enterprise, they are sold to another enterprise, or the persons which are specified by that other enterprise, and price and other conditions, they are influenced by such other enterprise, then also they'll become associated to each other. J, it talks about common control by individual and or relative. So if there is common control by an individual on one enterprise, and the individual's relative for the purposes of Income Tax Act, they are holding another enterprise, then these two enterprises will become associated to each other. Then if there is common control, by HUF or by its members and or relative. So in this particular situation, we will look at this example. Let's say that there is an HUF, it is controlling A Limited, and the member of the HUF or the relative of a member of such HUF it is controlling, B Limited. Well, then A Limited and B Limited will become associated to each other by virtue of clause K. L, in case of firm AOP BOI holding 10% or more interest in such firm AOP, BOI, that can become associated to each other. And then M talks about relationship of mutual interest, but nothing has been, prescribed as yet. So these are the control conditions that are essential, and they will cause association. Now we'll look at these particular questions and discuss whether they are related to each other or not. So just allow me a minute. Okay. So this one talks about, okay, state with reasons whether N LLC incorporated in Singapore and B Limited, which is a domestic company, are or can be deemed to be associated enterprises for the transfer pricing regulations. Each situation is independent of, the others. So first one, they're talking about N Limited. It has advanced a loan of 53 crores to B Limited on 12th January 2024. The total value of assets of B Limited is 100 crores. The market value of asset is 150 crore. B Limited has repaid 10 crores before 31st March 2024. So in this particular situation, yes, they will be associated to each other. Why? Because they have advanced a loan of 53% to the other enterprise, and the law says 51% or more. So it's actually 100 crores. You have to weigh that to 53 crores of loan that is actually, provided. You don't have to look at the market value because, the law says book value of total assets, and whether they have repaid anything or not, that does not count because the law says at any time. So at any time they had 53 crores, and that is what is to be counted. The second one talks about N LLC has the power to appoint two of the directors of B Limited, whose total number of directors is four. Now, because they have appointed not more than 50%, these are not going to be associated entities. And the third one talks about total value of raw materials and consumables of B Limited. It is 900 crores. Out of this, N Limited supplies to the tune of 820 crores at prices mutually agreed upon once in 6 months and dependent upon market conditions. Now, this is where I've stated the law. This is where I've provided, the law, right here, and it talks about supply of 90% or more. So you might feel that 90% or more is actually satisfied and this should be related, but no, they are not related. Why are they not related? Because it says that price and other conditions, they are depending upon market conditions. So it's not dependent upon their relation, it is depending upon market conditions. And this is the reason they should not be associated to each other. So what I'll do is I can give you maybe 1 minute right here to just go through these particular, examples, this question again, and just see if it makes sense. Let me know if, oh, sorry, these three, these three. So take 1 minute and go through these three examples. Okay, so now we'll move on to, the next topic that we have for today is international transactions. This is coming from Section 92B of the Income Tax Act 1961. And international transactions, this is what the law says. It says transactions between two or more associated enterprises, either or both of whom are non-residents. Now, these transactions could be in the nature of tangible property transactions, meaning to say that if there is purchase or sale or transfer, lease, use of tangible property or product. This includes building, vehicles, machinery, etc. Or there is intangible property. So if there is sale of intangible property or, purchase or transfer or lease or use of intangible property, it could include transfer of ownership or, use of rights or other commercial right. Or it could be a capital financing transaction. Now, this could be, long-term or short-term borrowing, or it could be a lending transaction. It could be a guarantee transaction, or, purchase and sale of securities or advances or receivables or payments or any debt, etc. That is also a valid international transaction. Or it could be provision of services. So if there is market research, if there is development, if there is technical service, if there is scientific research service, it could be legal or accounting service, etc. If it is provided by one entity to the other, then that is also considered as a valid international transaction. Or it could be business restructuring transaction. So a transaction of business restructuring, merger, demerger, reorganization with associated enterprises, that is also a valid international transaction for the purposes of Section 92B of the Income Tax Act. The next concept is deemed international transaction. Now, this is Section 92B, subsection 2 of the Income Tax Act that talks about deemed international transaction. Now, the concept we'll try to understand with the help of this particular case study. Let's say that there is an Indian enterprise, and this Indian enterprise is transacting with a foreign associated enterprise. Now, if these two enterprises they transact between themselves, there will obviously be transfer pricing provisions that will be applicable. Why? Because there is an Indian enterprise which is transacting with an overseas enterprise, a foreign associated enterprise. These two enterprises are associated to each other. So there will be transfer pricing provisions which will be applicable, and they'll have to undertake all the compliances, etc. So this is the reason they decide that let's have an unrelated party right here. What will happen is that the Indian enterprise will transact with the unrelated party, and there will be a prior agreement in relation to the relevant transaction or determination of terms of the transaction in substance, right here. This is the reason the transaction between the Indian enterprise and the unrelated person will become as a deemed international transaction. So transactions with unrelated parties, whether they are resident or non-resident, it is to be reported as a deemed international transaction under Section 92B, subsection 2 of the Income Tax Act. This concept is called as deemed international transaction. So I understand that these two entities, the Indian enterprise and the unrelated person, they're not related to each other, but this is going to be called as a deemed international transaction. We'll just deem it to be an international transaction, and transfer pricing provisions will be applicable right here. So this is what the law says. A transaction entered into by an enterprise with a person other than an associated enterprise. That can also be a deemed international transaction if there exists a prior agreement in relation to the relevant transaction between such other person and the associated enterprise, or the terms of the relevant transaction are determined in substance between such other person and the associated enterprise, and where such the enterprise or the associated enterprise or both of them are non-residents, irrespective of whether such other person is a resident or not. So it does not matter whether the other person is a resident or not. This was the amendment that was introduced by Finance Act of 2014. Finance Act of 2014, it expanded the scope of deemed international transaction, and they included transactions between Indian entity and the non-AE Indian entity. So in this example, the transaction between ICO and this non-AE, they're both in India. This transaction can also be a deemed international transaction. Now, we do understand that they're both with Indian entities, but still it can be under the deeming provision deemed to be an international transaction, and transfer pricing provisions will be applicable right here, only if there is a prior agreement for supply of goods from ICO to the non-AE, right here. So this was the Finance Act 2014 amendment. Now we'll go on to the next topic, which is called as overview of transfer pricing methods. This is the chapter where we'll be discussing the 6 methods that are provided under the transfer pricing law for transfer pricing purposes, obviously. So these are, the 6 methods right here. The methods are divided into two, which is the traditional transaction methods, and then there are transactional profits method. Now, within the traditional transaction method, there is something called as the comparable uncontrolled price method, which is CUP. Then there is the resale price method, which is RPM. And then there is something called as the cost plus method, which is CPM. Now, within the transactional profit methods, there is the transactional net margin method, which is TNMM. Then there is something called as, the profit split method, PSM. And then there is other method, which is the any other method which is provided in Rule 10A-B. Now, if you look at, the traditional transaction methods, which is CUP, CPM, and RPM, these are direct methods. These are direct methods as the comparison is far more easier. The adjustments are not required, are not that complex, if at all. And the transactional profit methods, these methods are useful where each of the parties, they make unique and valuable contribution in relation to the controlled transaction. Now, there is no hierarchy of method which is, provided, because we rely on a concept which is called as the most appropriate method. Now, this is what Rule 10C Subrule 1 of the income tax rule says. It says that the method to be selected should be the one which is best suited to the facts and circumstances of each international transaction or specified domestic transaction, and that provides the most reliable measure of the arm's length price. This concept is called as the most appropriate method. So there is no hierarchy of method, but whatever is best suited to the facts and circumstances of, the situation, that is the method that will be adopted right here. We'll start with the first method, which is called as the CUP, which is the comparable uncontrolled price method. The comparable uncontrolled price method basically says what is the price which is charged in a controlled transaction that is actually compared with the price which is charged in a comparable uncontrolled transaction. So what you have to do in this particular situation is look at an independent party transaction. Now, that independent party transaction, is it comparable? If yes, then just adopt that price as the CUP price, as the comparable uncontrolled price. This is the most direct method and it is preferred by tax authorities, globally. It can be used as CUP if one of the following conditions is satisfied, as in none of the differences between the transactions being controlled, compared, could materially affect the price in the open market, or if they can affect the price, then reasonably accurate adjustments can be made to eliminate, such differences. So that is the comparable uncontrolled price. Now, as far as CUP is concerned, there are two types of CUP right there. There is something called as the external CUP, and then there is something called as internal CUP. In external CUP, let's look at the first situation. In this AE1, it sold unbranded Colombian coffee beans to AE2. However, it did not sell any unbranded Colombian coffee beans to third party. It was just to AE2. Now, there is also sale of unbranded Colombian coffee beans of similar type, quality, and volume between non-AE1 and non-AE2. Now, to benchmark this transaction between AE1 and AE2, what we can do is use this particular external CUP price. And whatever is this particular price, external CUP price, we can adopt it as this price between the controlled transaction. This is called as the CUP transaction. There is another kind of CUP which is called as, something called as the internal CUP. Now, in internal CUP, let's say that there is ICO 1 and they have sold unbranded Colombian coffee beans to ICO 2. which is, the non-AE right here, this one, non-AE. Now, ICO has also sold unbranded Colombian coffee beans of similar type, quality, and volume to FCO. And in this, it owns 100% preference share and 28% equity share. Now, because there is 28% equity share, that basically means that ICO and FCO are associated to each other. Now, we need to find out the price of this controlled transaction. Now, this is the uncontrolled transaction. This is the internal CUP, transaction. And this is the price that we will adopt to benchmark this transaction. So this is basically called as internal CUP. The next kind of method that we have is resale price method. In resale price method, what happens is that the property purchased or services obtained from a related party are resold to an independent party. And this is the reason they call it a resale price method. So let's say that there is a parent company and they're outside India and they want to sell some products to India. So what they do is they sell it to a subsidiary company in India, and the subsidiary company sells it to the end customer in India. So let's say that the parent company sold it at 75 rupees to the subsidiary company, and the subsidiary company is selling it at 100 rupees to the end customer. Now, the controlled transaction right here is this transaction between the parent company and the subsidiary company right here. So this transaction between the parent company and the subsidiary company, which has happened at 75 rupees, we need to benchmark, we need to say that this is at arm's length price. How will we do that? Let's say that what is the profit which is made by the subsidiary company? Well, the profit by the subsidiary company is, let's say, 25%. How? 100 minus 75. So it's 25 margin that they have actually made, 25%. So the price which is paid by the subsidiary company to the AE, it will be at arm's length if 25% resale margin, which is earned by the subsidiary company, it is equal to or it is greater than the margins which are earned by similar Indian distributors. This is called as the resale price method. But one thing that you have to remember is that there should be no major value addition to goods purchased or services which are obtained by associated enterprises. Then there should also be no intangible asset which is applied to add value to goods resold. Then this is most useful in case of traders and distributors, and it is not applicable when goods purchased from AE are also sold to the associated enterprise. So these are some of the pointers that you have to remember for the resale price method. The next one is cost plus method. Cost plus method is the method where which basically compares and identifies the markup which is earned on direct and indirect cost of production, which is incurred with that of comparable independent companies. Now, in this particular situation, let's say that there is a subsidiary company right here. It has some direct cost and indirect cost of production, let's say of 100 rupees. Now, it manufactures the commodity at 100 rupees and then it sells it to the parent company at 125 rupees. So the transfer price is 125 rupees. Now this is the controlled transaction, that we have right here. Now we need to benchmark this transaction. We need to just say that this kind of transaction is at arm's length. So what we'll do is we'll look at the profit which is earned by the subsidiary company of 25%. And if this particular margin of 25% is uh, greater than other comparable distributors, then this is at arm's length. So this is a preferred method in case of semi-finished goods which are sold between related parties and contract manufacturing agreements. It is to be applied in all the cases which are involving manufacture, assembly, or production of tangible, products or services that are sold or provided to associated enterprises. Now, there must be consistency in the cost base between controlled and uncontrolled transaction, specifically in the circumstances where costs have, the effect on the size of markup. Now, the problem is that as the term direct and indirect cost of production are not defined anywhere, it can be a little difficult to determine the cost, especially for comparable uncontrolled transactions. But then, as long as that is sorted, it should be, good to go. So this is basically the cost plus method. What you have to remember for the purposes of cost plus method is that this is for contract manufacturing. It is for manufacturing situations that cost plus method is actually applicable. Now, the next method that we have is the transactional net margin method. Now, the transactional net margin method, this is a method which examines the net profit relative to an appropriate base. So what it will actually do is you have a controlled transaction. You'll have to calculate the net profit which is earned in this controlled transaction. And then you have an independent party transaction. You'll have to look at the net profit earned there. And then you have to compare the both, the controlled transaction and the uncontrolled transaction to see if the control transaction is at arm's length. So TNMM, it examines the net profit, which is relative to an appropriate base. Now it could be net profit divided by cost, net profit divided by sales, net profit divided by assets. The results which are obtained are compared with the operating profit margin of an independent, uncontrolled third party, which is engaged in comparable transaction relative to the appropriate base. So what you'll do is you'll compare the net profit by sales to net profit by sales of independent party. Net profit by cost of related party, compare it with net profit by cost of unrelated party, and then decide if this transaction is at arm's length or not. Now this kind of sorry now this kind of uh, this kind of you know indicator that you have, this kind of ratio that you have is basically called as the profit level indicator. Now this PLI or profit level indicator, it is the ratio of net profit to an appropriate base. This could be, cost asset sales of the controlled transaction. It should be compared with the profit level indicator of the uncontrolled transaction. Now this could be gross margin ratio, operating margin ratio, or net cost, plus ratio. So this comparing of net profit, this is called as the transactional net margin method. This is the concept in TNMM, which is called as, the tested party. Now, what are you trying to verify? If there is a transaction between an Indian entity and the US entity, which entity will you compare the net profit for? Is it going to be the Indian entity or is it going to be the US entity? Well, this is called as the tested party. The verification of the controlled transaction is done from the perspective of the tested party. So you'll have to decide whether India is the tested party or you will have to decide whether US is, the tested party. Now, the thing is that there is no definition of tested party in transfer pricing regulations. It's always going to be, they say, the least complex entity which will become as, or which will be selected as, the tested party. Now, there are a few factors because this is not, defined in law. They have provided a few factors out there for the selection of tested party. These factors are availability and reliability of information. Then whatever party does not own significant intangibles, that will become as, the tested party. And they should require least adjustments, that will become as, the tested party. So this concept is going to be called as the tested party. So this concept is called as the TNMM, the transactional net margin method. After this, what we have is something called as the profit split method. Now, the profit split method is applicable where transactions are so interrelated that they cannot be evaluated on an individual basis. So, if the transactions are very, very related to each other, or if the transactions have some element of intangible assets, then it will be useful to use something called as the profit split method. So, this is where transactions are so interrelated that they cannot be evaluated on an individual basis. This is where selecting this method would be appropriate. Now, the contribution of each enterprise, it will be based on a thorough functional analysis, and it will be valued to the extent possible from available, reliable external market data. So it could be, like a profit split percentage, or it could be returns which are obtained between observed among, independent enterprises and with comparable functions. This is called as something called as the profit split method. The last method that we have is something called as the other method. The other method is something which is very specific to India. It's not there in the OECD transfer pricing guidelines. It's something which is, very specific to India. Now, the other method basically means that you are using third-party quotations, or the price which would be charged for similar or same or similar uncontrolled transactions. That is called as the other method. So other method, it allows the use of any method which takes into account the price which has been charged or would have been charged or paid for similar or same uncontrolled transactions with or between non-associated enterprises under similar circumstances. Now, the various data which may be possibly used for comparability purposes for this particular method, for the other method, it can be third-party quotations, it can be valuation report, it can be tender documents, bidding documents, it could be document relating to negotiation, it could be standard rate cards, or commercial and economic business models. These can be used for the purposes of other method. So with this, I think we finished with all, the methods out there. This is a slide for summary which talks about, which method is going to be used when. So this is, the COP method. It can be used for, loan transactions, service fee transactions, or any transaction for that matter. As long as you have data available, it's going to be the COP method that can be used. Transfer of tangibles, sale and purchase of goods, etc. Now, the next is RPM that we discussed, which is resale price method. This is applicable for distributors which are not adding any value. Then it is the cost plus method. It is for manufacturers and it is for sale of raw materials and semi-finished goods. Then there is something called as TNMM. It is for manufacturing, it is for sale of goods, provision of services, etc. And finally, there is something called as PSM, which is where the transactions are very, very related to each other, interrelated, or where there is an existence of unique intangibles. And that is where we have, the profit split method applicable. So this is like a slide in, summary. Now we have three questions, out here where we have to state with brief reasons which method will be appropriate in these kind of, cases. I'll give you 1 minute to read through these particular, or 2 minutes to read through these particular, scenarios, the three scenarios, and then we can discuss it. So just read through these scenarios. Okay, so let's look at the first situation right here, they talk about A Co Limited, which is in Mumbai. It is engaged in the manufacture of garments. It manufactured and supplied as per the variation in customization and finishing of products to its associated enterprise X in UK as compared to the goods regularly sold, to third parties. Now, this is where TNMM could be very appropriate because in this particular situation, you can compute the net profit of, using the PLI of the controlled transaction and then compare it to the uncontrolled transaction because the information for uncontrolled transaction is also, provided here. The second one talks about DEF Co. Limited. It is engaged in the manufacture of, medicines, and it manufactured semi-finished drugs in bulk and sold to related parties located in India and outside India. It adds gross profit markup on direct and indirect cost of production. Now, there are a lot of terms that could signal you that cost plus method is going to be the most appropriate method. The first thing is that this is for manufacture of medicine. Cost plus method is where manufacturing is applicable. Now, it adds a gross profit markup also on direct and indirect cost of production. So this sort of fig signals that a cost plus method could be appropriate. ZY Limited Bangalore provided identical call center services to both related and unrelated parties. Now, this is a classic example of, the CUP method that can be used here, the comparable and controlled price method, because they have provided information on both, the related party, and they have been provided information for the unrelated party also. So, this is where a CUP method could be applicable. Now, the next concept that we have is the data to be used for analyzing comparability. This is where they talk about multiple year data. So, can you use multiple year data or not? This is where the law says yes, multiple year data can actually be used. So, the data which is to be used in analyzing the comparability, it shall be the data relating to the current year or the financial year in which the international transaction has been entered into. But this is where CBDT came up with a change in law, and they amended Rule 10b-4 um, uh, to clarify that, where you're using RPM, TNMM, or CPM as the most appropriate method, then you can use arm's length price relating to the data relating to the current year or the data relating to financial year immediately preceding the current year if current year data is unavailable at the time of furnishing return of income. Now, the problem is that current year data may be distorted by differences in economic or market conditions. And the purpose of using multiple year data is to basically ensure that outcome is not unduly influenced by abnormal factors or differences. Hence, the data which is relating to a period of up to 2 years, which is prior to such year, may also be considered if it reveals facts which could influence the ALP. The next is the use of arithmetic mean and interquartile range. Now, Indian transfer pricing regulations, they prescribe the concept of arithmetic mean. It is to be coupled with a tolerance range where the number of comparable companies in a data set is less than 6. Till 5, you can use the arithmetic mean, where the variation between the arm's length price and the transaction price is less than 3%. If it is less than 3% of the latter, then it may be regarded as compliant with the arm's length principle. Now, to align transfer pricing regulation with global best practices, the Finance Act of 2014, they introduced the concept of arm's length range. This is like interquartile range, which is introduced by OECD regulations. So it is applicable to all methods except profit split method and other method. 35th to 65th percentile of the data set can become the interquartile range, but this is only when 6 or more than 6 comparable companies are provided. Now, this is where use of range is closer to economic realities of price comparison than a particular point. The particular point is arithmetic mean. This is the reason the concept of range is much better as compared to arithmetic mean. But then you have to look at the number of comparable companies, that are applicable to decide whether arithmetic mean is to be used or range concept is to be used. The next topic that we have is transfer pricing documentation. Now, this is the importance of transfer pricing documentation. It basically helps the multinational companies, stay away from transfer pricing penalties. So if you look at, the transfer pricing analysis, it's basically an elaborate process. It includes scrutiny, evaluation, judgment, and thorough documentation in the form of a transfer pricing study. So there is a dual purpose of this particular documentation transfer pricing study report. One, it helps you to adhere to legal obligation of maintenance of mandatory information. And then if there is department assessment, it substantiates for justifying the transfer pricing policies. So this is the dual purpose that it basically performs. Now, as far as transfer pricing documentation is concerned, there is something called as accountant's report. This is coming from Rule 10E, Section 92E. They talk about something called as an accountant's report. This is a mandatory report that is to be obtained by every person who's entering into an international transaction or there is specified domestic transaction. And then there is mandatory e-filing by 31st October of the assessment year. Now, this particular accountant's report is going to provide an opinion whether the value of international transaction or specified domestic transaction is at arm's length. And this is going to certify the value of international transaction as per books of accounts and transfer pricing documentation is true and correct. Now, as far as the accountant's report is concerned, this is called as Form 3CEB. The details that are to be furnished under accountant's report are the details of all the associated enterprises with whom transactions were entered into. So, their name, their nature of relationship, the brief description of business, etc. Then the following details for each category of transaction. So the category of transaction could be, traded goods, finished goods, raw materials, tangible product, intangible property, service transaction, deemed international transaction, lending, borrowing. It could be guaranteed transaction. It could be capital transaction. It could be mutual agreement for cost contribution. It could be business restructuring, any other transaction, or even for specified domestic transaction. So for all these transactions, you have to provide the associated enterprise details. You have to provide the description of transaction. You have to provide the volume of the transaction, the units in case of tangible property transaction. Then you have to talk about the total amount which is paid or payable or received or receivable. This has as per the books of accounts and as per computed by the assessee having regards to the ALP. And then you have to talk about the most appropriate method which is used. So these are the details that are to be provided under the accountant's report. After that, there is something called as the transfer pricing study. This is section 92D or rule 10D. Now, this is just a background to the transfer pricing documentation. A lot of information goes in the transfer pricing documentation. This is going to be enterprise-wise details, like, what is the ownership structure and linkages with the associated enterprise, what is the profile of the group, what is the details of the AEs, what are the name, addresses, legal status, or in the country of tax residence, what is the business of taxpayer and industry overview. Then there will be transaction specific details like, what are the transaction details, including the pricing of information, the quantum and value of each transaction. Then what are the FAR analysis, the function assets and risk analysis, what are the economic market analysis, budget, estimates, and then the details of the uncontrolled transaction. And finally, it's going to be computational related details that will go in the TP study, which is going to be what is the most appropriate method, what is the computation of ALP, or what are the TP adjustments, or any other information which is just very relevant for the determination of ALP that will also go in the TP study. Now, as far as the TP study is concerned, there is a threshold limit out there. If the aggregate book value of international transaction, if it does not exceed 1 crore, well, it is not mandatory to maintain the prescribed information. But still, you need to justify and substantiate, that the income which is coming from international transaction, it is as per Section 92 of the Income Tax Act. Then there is also a period of maintenance of documentation. Now, the date, which is 1 month prior to the due date of furnishing return of income, that um, um, this particular documentation, it is to be retained for a period of 8 years from the end of the relevant assessment year. Now, these were the two things that were required under India, Form 3CEB, as I mentioned, Accountant's Report, and the Transfer Pricing Study Report, Section 92D. Now, after this, OECD came up with Action Plan 13, OECD BEPS Action Plan 13, which is the three-tier documentation structure. The OECD said that you need to maintain a three-tier documentation structure for the purposes of transfer pricing. The three-tier documentation structure involves, there should be like a local file, there should be a master file, and then there should be a CBCR. The local file and the master file, they are to be filed before local tax authorities. So now the local file is like an entity specific document. It is going to describe, information which is related to related party transaction between a local country affiliate and AEs in different countries. So all material related party disclosures will go in the local file. These could be, entity, sorry. These could be entity specific details or, detailed functional analysis, economic analysis. Then there is something called as a master file. The master file is to be filed before local tax authorities. Now, this is going to have, this is going to be a high level overview of business of the international group, the nature of its, global business operations, overall transfer pricing policies, and global allocation of income and economic activities. So it's going to include, the supply chain, the value drivers, etc. And this is going to involve the key service arrangements, the R&D centers, etc. Apart from this, what is important is that there should be a country by country report, CBCR. This is to be filed in the parent's jurisdiction. The CBCR, it is to be filed by the parent entity, or it could be the alternate reporting entity of the multinational company, and it is to be filed to the prescribed authority in its country of residence. So it will include, like aggregate tax jurisdiction wise information relating to the global allocation of income and taxes which are paid by the multinational group. It's going to include revenue, profit before income taxes, income tax paid and accrued. Then it's going to include the employees, the stated capital, retained earnings, tangible assets in each jurisdiction, etc. So this was, one of the questions. This is one of the questions that was, provided in the past papers for 3 marks. It says under BEPS Action Plan 13, BEPS report recommends that countries adopt a standardized approach to transfer pricing documentation, wherein it mandates the three-tier structure: master file, local file, and country by country report. So what are the advantages of the three-tier structure, which is mandated by BEPS Action Plan 13? So you have to mention 3 advantages. It's coming for 3 marks. So the advantages are that, after this, the taxpayers will be required to articulate consistent transfer pricing positions. Tax administrations will also get useful information to assess transfer pricing risk. And tax in administration, they will be able to make determination about where their resources can be most effectively deployed. And in case audits are called for, it's going to provide information to comments and target audit inquiries. So this is what, was actually needed. Now, as far as documentation is concerned, there is also a threshold limit out there. There is a threshold limit for applicability of CBC reporting. This is coming from section 286 subsection 7. The reporting provision, it will apply in respect of an international group. This is going to be for an accounting year only if the total consolidated group revenue, which is reflected in the consolidated financial statements for the accounting year, um, preceding such accounting year is above a threshold which is 6,400 crore. So what I'm really trying to say is that the threshold for CBC, and this threshold is as per the total consolidated group revenue in the consolidated financial statements. This threshold should be 6,400 crore rupees. INR 6,400 crore, only then CBC will be applicable. Now, just to clarify, this one has a threshold of 6,400 crore, the country by country report right here. Now, there is a threshold for master file also. Now, this is Rule 10DA sub Rule 1, which talks about the requirement of master file in India. Now, every person, which is, let's say, a constituent entity of an international group, now, if the consolidated group revenue of the international group, of which this person is a constituent entity, this uh, group revenue is coming from consolidated financial statements. If it exceeds 500 crore, then master file will be applicable. But there is another threshold out there, and the aggregate value of international transactions during the accounting year, as per books of account, it exceeds 50 crore. Or for intangible transactions, this could be purchase, sale, transfer, lease, or use of intangible property. As per the books of account, it exceeds 10 crore. Well, then master file will be applicable. So, meaning to say, the consolidated group revenue of 500 crore plus, if there is international transaction during the year, then it should be 50 crore. And if there is intangible transaction, it should be 10 crore. Only then master file will be applicable. Now, master file has two parts to it. There is part A of Form 3CA 3CEAA, which is basically the master file. It is to be furnished by every person, being the constituent entity of an international group, whether these conditions are satisfied or not. So part A is mandatory, and then there is part B, which will depend on these particular thresholds right here. So this is basically the transfer pricing documentation that you have to remember. You have to remember that there is something called as Form 3CEB, which is mandatory to be filed. Then there is TP study, which is to be maintained. And this is all the information that goes in, the TP study. And then there is the 3-tier documentation structure, which is provided by the OECD. It has something called as the master file, the local file, and the country by country report. The local file is to be filed with the local tax authorities. The master file is to be filed with, again, the local tax authorities. And for CBCR, that is to be filed in the parent jurisdiction. So India adopted these recommendations of OECD BEPS Action Plan 13 in Section 286. So Section 286 talks about CBCR, and this is where the threshold for CBCR in India is 6,400 crore rupees. And this is the requirement for master file that we just, read. And local file is the TP study that we already have, in India. So this is the transfer pricing documentation. Now, the next topic that we have for today is basically safe harbor rules, which is coming from section 92 CB. What we'll do is we'll take a 15-minute break, and then we'll come back and discuss something called as safe harbor rules. We'll discuss advanced pricing agreements, APAs. Then we'll discuss secondary adjustment, and finally we'll discuss limitation of interest deduction, and then advance ruling. So we'll take a 15-minute break and come back and discuss all these topics. So starting with a 15-minute break. transfer pricing. And within that, the new topic that we need to start for now is going to be safe harbor rules. Now, safe harbor rules are basically coming in from section 92 CB of the Income Tax Act. What is a safe harbor rule? Well, safe harbor is, more like defined in the Income Tax Act. These are circumstances in which the income tax authorities, they will accept the transfer price or income which is deemed to accrue or arise under section 911, as the case may be, which is declared by the assessee. Now, just to give you a background, there was a lot of dispute relating to the margin which is earned by related party transaction. So, if a related party transaction is in contract research and development, the margin that they were earning in India, let's say, was 15%. Now, the tax authorities said that no, 15% was not sufficient, but the taxpayers said that no, 15%, was fine. So this is the reason there was a lot of dispute, and this is the reason they came up with something called as, the safe harbor rules. So now they have defined circumstances, as in if you're doing this kind of transaction, then what is the transfer price or the income that will be declared by the assessee, and it shall be accepted by the income tax authorities. So from the perspective of transfer pricing provisions, the safe harbor, it provides a window for the taxpayers. So in simple words, from the perspective of transfer pricing provisions, safe harbor rules, they provide a window for the taxpayers, wherein in case of defined circumstances, the income tax authorities, they will accept the transfer price which is declared by the taxpayer. So it obviously provides, certainty, it provides compliance relief, and there is administrative simplicity. Now, these are, the eligibility for safe harbors. Obviously, this is not like exhaustive list. It goes way beyond, but just to give you a little idea on, the eligibility. So it could be for software development services. It could be for ITES, which is information technology enabled services. It could be for KPOs, knowledge process outsourcing services. It can be for contract research and development, which is relating to software development. It could be contract research and development services, which is relating to general pharmaceutical drugs, or advance of intra-group loans, or receipt of low value adding intra-group services. Then even a specified domestic transaction which is undertaken by an eligible assessee, and which comprises of, let's say, supply of electricity, transmission of electricity, wheeling of electricity, or purchase of milk or milk products by a cooperative society from its members. So this is the eligibility for, safe harbor. Just as an example, on this particular slide I have provided, let's say that there is provision of software development services, then the operating margin which is declared by the eligible assessee from the eligible international transaction in relation to operating expense incurred is not less than 20%, where the aggregate value of such transactions does not exceed a sum of 500 crores. And if it exceeds 500 crores, then it should not be less than 22%. So this is the reason they've defined the circumstance and the transfer price, which should be accepted by the tax authorities. So this is basically safe harbor rules. The next that we have is something called as advance pricing agreements. This is section 92CC and section 92CD of the Income Tax Act. And this is where, again, this is like a dispute resolution mechanism, which is, provided there. Now, what is APA? Well, APA is more like an agreement between the tax authorities and the taxpayers, and they will sit and decide that, if there is a disputed transfer pricing transaction. Sorry. If there is a disputed international transaction, they will come to an appropriate transfer pricing methodology. So this is the reason, if you look at APA, it's more like an arrangement, and it determines in advance of the controlled transaction an appropriate set of criteria. So it's going to determine, the methods, the comparables, appropriate adjustments, critical assumptions, etc., for the determination of the transfer pricing for those transactions over a fixed period of time. So in other words, it's more like an arrangement. It's more like an agreement between the taxpayer and the taxing authority, and an appropriate transfer pricing methodology for a set of transactions over a fixed period of time in future. And the best part is that they offer certainty and unanimity of approach. So that's basically an APA. Now, as far as APA is concerned, if there is an APA which is entered into, it shall be binding on the person in whose case and in respect of which the transaction relating to the APA has been entered into. So the person who has taken the APA and the principal commissioner or the commissioner of income tax authorities subordinate to him in respect of the said person and the said transaction. APA will not be binding if there is change in law or there is change in facts. The provisions of the APA, it shall override the provisions of Section 92C and Section 92CA, which are normally applicable for the determination of ALP. So if you look at APA, the whole concept is basically based on negotiation, and it's going to require the consent of the signing parties. It is based on assumptions and it requires verification before application. There has to be continual monitoring to ensure validity. There is also a APA filing fee, and it is dependent on the value of international transaction. So up to 100 crores, the APA filing fee is 10 lakh. From 100 crore to 200 crore, the APA filing fee is 15 lakh. More than 200 crore, the APA filing fee is 20 lakh. And then there is also something called as a rollback provision in APA, where you can take APA for the previous years also. So in India, you can roll back to 4 previous years. So for rollback, there is a APA filing fee of 5 lakh. So if you look at the concept of APA right here, it is valid for the period which is specified in the APA, but then it's not going to exceed 5 consecutive financial years. So maximum that you can take APA is for 5 consecutive financial years. It can obviously be extended or renewed for a further period of up to 5 years. So going forward, you can take APA for 5 years. Now, as I mentioned, the rollback provisions are also applicable, and you can roll back 4 years maximum prior to the first year of the APA period. So maximum 4 years prior to the first year of the APA period. So if you look at, the taxpayer would be able to take APA for maximum 9 years. How 9 years? Well, you can take it maximum for 5 years going forward, and backwards rolling back, you can take it for 4 years. So it becomes a maximum period of 9 years that you can have certainty in matters of transfer pricing. So that is the entire concept of APA. Now, this is where I have, mentioned just a few, I have mentioned about, a few things, a few sections relating to APA. The first thing is, do you think APA can be revised? Well, if there is change in critical assumptions, if there is change in law, or if there is request from the competent authority of another country, well, then APA can be validly revised. So it is also for conversion of unilateral APA to bilateral, etc. Then the thing is, can APA be cancelled? Well, under APA, there is something called as an annual compliance report. If there is failure to file this annual compliance report, well, then APA can be cancelled. Then if there are material errors in the annual compliance report, then also APA can be cancelled. If there is adverse finding during the annual compliance audit, well, then also APA can be cancelled. And if the taxpayer is not, in agreement with the proposed revision, well, then also APA can be cancelled. Now, the point is, APA is taken for a maximum period of 9 years. Is there a renewal of APA which is possible? Well, there is a same, yes, there is renewal of APA that can be possible. It is going to be the same procedures as initial APA request, but it is advisable to file, the renewal application before the expiry, because renewal is to be completed in a relatively shorter, time frame. So APA can be renewed also. The next thing is, can the APA be withdrawn? Yes, withdrawal of APA is permitted before APA finalization, but then the thing is that the taxpayer, they will have to provide for the reasons, for withdrawal. And the thing is, the fee that you have paid for APA, it will not be, refunded. So yeah, these are, some of the sections relating to APA that you can probably look at. So I'll give you 1 minute to just, look at this particular slide on the APAs. Okay. The next is about questions from past papers about, APA. So let's look at the first question right here. So the first question is pertaining to May 2018, and they talk about company X and company Y. Now they have entered into APA and they were eligible for rollback provisions, but they merged to form a new company, which is XY. Now the thing is the company XY, is it eligible for rollback provisions, as it was formed on merger of company X and company Y? Well, this is where you have to understand that the agreement for APA, it is between the board and the taxpayer or the person. Now, the principle to be followed here is that the person who makes the APA application alone would be entitled to enter into the agreement, and they will be entitled to rollback provisions for the international transaction for which rollback is taken. Now, because X and Y were the APA applicants and XY was not the APA applicant, their new company XY was formed after, merger. Company XY would not be eligible for rollback provisions right here. The next question was a question from November 2019, and they say that an APA, which is an advance pricing agreement, once entered by the taxpayer with the income tax authorities, cannot be modified or revised. Well, this is not correct. This statement is not correct, because we just discussed how an APA can be modified or it can be revised. There is revision of APA that is, provided right here. So this statement is also not correct. Now, the next topic that we have is basically secondary adjustment. Now, what is secondary adjustment? Before we actually get into secondary adjustment, we have to understand the concept of primary adjustment. So there is something called as primary adjustment, and then there is something called as secondary adjustment. Now, primary adjustment to a transfer price, it means the determination of transfer price in accordance with the arm's length principle, resulting in an increase in total income or reduction in loss, as the case may be, of the assessee. Meaning to say, all this while we were discussing this case study. So I mentioned that in this particular case study, they transacted at 80 rupees. It was not right. They should have transacted at 120 rupees, because that was the ALP. So what will happen in this situation? The tax authorities will add back 40 rupees of profit. That adding back of 40 rupees or 40 units of profit, that is called as primary adjustment. Increase in total income of the assessee, this is basically primary adjustment. Now, after primary adjustment has been undertaken, it's important to remit that amount from the associated enterprise. So this will help remove the imbalance between cash account and actual profit. This is called as secondary adjustment. So secondary adjustment, it's more like an adjustment in the books of accounts of the assessee and the AE, and it will reflect the actual allocation of profits between the assessee and its AE. They are consistent with the transfer price, which is determined as a result of primary adjustment, and this will help remove the imbalance between cash account and actual profit of the assessee. So now secondary adjustment provisions, they were introduced in transfer pricing cases in India in Finance Act of 2017. Secondary adjustments are designed to ensure that the cash profits of the taxpayer, they are in line with the tax profits following a primary adjustment. So only if there is a primary adjustment will a secondary adjustment actually happen. Now, in accordance with the secondary adjustment provisions, where as a result of primary adjustment to the transfer price, there is an increase in total income or reduction of loss, well, the excess money, which is the 40 rupees here, or part thereof, which is available with its AE, will have to be repatriated to India. If the repatriation is not made within prescribed time, the excess amount as a result of primary adjustment is like advance. We'll just deem it to be an advance which is made by the taxpayer to the associated party on which notional interest is charged and offered to tax by the Indian taxpayer. Basically, secondary adjustment provisions are introduced so as to make sure that profit allocation between AEs are consistent with primary adjustments. So this is the slide which says when secondary adjustment will be applicable. Secondary adjustment will be applicable if there is a primary adjustment which has been made suo motu by the assessee in their return of income, or where primary adjustment has been made by the AO and it is accepted by the assessee, by the assessing officer, and it has been accepted by the assessee, or where primary adjustment to the transfer price is determined by the APA, which is entered into by the assessee, or where primary adjustment is made as per safe harbor rules, or where primary adjustment to transfer price is as a result of resolution or by map under DTL. So such secondary adjustment, however, it shall not be carried out if the amount of primary adjustment made in the case of assessee, it does not exceed 1 crore rupees, or if the primary adjustment is made in respect of AY assessment year 16-17 or earlier assessment year. So this is the slide that talks about, secondary adjustment in a summary form. Secondary adjustment may take the form of, constructive dividends, constructive equity contribution, or constructive, loans, etc. So that is really the concept of, secondary adjustment. So this is where they say that if there is an Indian company and they have transacted with a non-resident AE, if the transaction is not at ALP, so, there is resulting in increase in total income or reduction in total loss, and there is a primary adjustment of more than 1 crore rupees, well, then secondary adjustment will come into play. And if the amount is not remitted to India within 90 days, then this is going to be like a loan. It's like a deemed loan by the Indian company to the non-resident AE. And then there will be interest on this deemed loan, and it will be added in the hands of the Indian taxpayer. Now, what if there is no repatriation? Now, if there is no repatriation, if it is not repatriated to India within the time, then we'll treat it as an advance which is made by the AE, and it shall be computed as the income of the assessee. Now, it can be, the repatriation can be made by any of the AEs of the assessee. And this is the slide that talks about, the time limit within which repatriation has to be made. So this is Rule 10 CB Sub Rule 1, and it prescribes the time limit for repatriation of excess money or part thereof. It is going to be on or before 90 days from the date which is given in this particular column, column 3, in cases which is mentioned in column 2. So just take a minute and read through this particular, slide. Just take 1 minute and read through this slide, and then we'll discuss it. Okay, so the cases which are mentioned is where primary adjustment has been made suo motu by the assessee in its return of income. Then the date for 90 days is going to be the due date of filing of return under section 1391. Where it is by the AO, primary adjustment is made by the order of the EO, then it's going to be the date of the said order. Where it is with respect to the APA, well, then it's going to be the date of filing of APA. Where the option has been exercised by the assessee as per safe harbor, then the due date of filing return. And if it is MAP, well, then the date of giving effect by the AO under Rule 44H of such resolution. So this is the time limit which is provided for the purposes of MAP. Now, this is, what if there is, no repatriation? Well, the imputed per annum interest income or excess money, which is not repatriated within the time limit, how will that be computed? Well, where the international transaction is denominated in Indian rupee, well, then it's going to be at 1 year marginal cost of fund lending rate of SBI as on 1st April of the relevant previous year plus 325 basis point. And where the international transaction is denominated in foreign currency, well, then it's going to be at 6-month LIBOR as on 30th September of the relevant previous year plus 3%. So this is, how the interest is going to be imputed. Now, the CBDT has not yet issued a blanket replacement formula for the purposes of, LIBOR, but they have acknowledged the move away from, LIBOR. Now, this is the last slide when it comes to, secondary adjustment. And this is where they talk about, an option to pay additional tax if the excess money is not repatriated at all. Now, in a case where the excess money or part thereof has not been repatriated within the time prescribed, as mentioned above, the time which has been prescribed, the 90 days, the assessee has the option to pay additional income tax. And this is going to be at the rate of 20.9664%. It's going to be taxed at the rate of 18%, plus it's going to be a surcharge of 12%, plus a cess of 4% on such excess money or part thereof as the case may be. Where the additional income tax is so paid by the assessee, then they will not be required to make secondary adjustment and compute interest from the date of payment of such tax. And this implies that he would in any case be required to compute interest up to the date of payment of such additional tax. But then this will be like the final, thing ever. The additional income tax so paid by the assessee, this will be treated as the final payment of tax in respect of excess money or part thereof and not repatriated, and no further credit would be allowed to the assessee or any other person in respect of the amount of additional income tax paid. So this is going to be the final thing, and no credit will be allowed, for this. Then no deduction in respect of the amount on which such additional income tax has been paid would be allowed under any other provision of, this particular act. So that is if you pay the additional income tax. Now, this is one question that we will be, discussing. This is what will be the consequences if suo motu enhancement to the transfer price of 14.40 crore is made by Sugandha India on the determination of ELP of international transaction while filing return of income. Now, a lot of things you have to take in mind. The first thing is that, there is a suo motu enhancement of transfer price. So there is a primary adjustment. The primary adjustment is more than 1 crore rupees. So it will be applicable. Secondary adjustment will be applicable. So all this you have to mention here. Now, where Sugandha Limited has made an enhancement of 14.40 crores to its total income on determination of transfer price in accordance with the ALP, that is, it has suo motu made primary adjustment in its return of income, then the excess money which is available with its AE, which is 14.40 crore, it should be repatriated to India within 90 days from the due date of filing of return of income under 139(1). The same is required because primary adjustment is exceeding 1 crore. When the sex when the said money is not repatriated, uh, to India within the prescribed time, then it shall be deemed to be an advance, which is made to the AE, and interest on such advance will be computed at, if this is an international transaction in Indian rupees, then 1 year lending rate MCLR of State Bank of India as on 1st April plus T 325 basis point. Or if this is an international transaction denominated in foreign currency, then it's going to be 6-month LIBOR plus 300 basis point. In case the excess money or part of excess money is not repatriated within prescribed time, then they will have the option to pay additional income tax at the rate of 18% plus surcharge and cess on such excess money or part thereof. If the assessee pays the additional income tax, they will not be required to make secondary adjustment or compute the interest. So that is the entire gamut of secondary adjustment cases that you should be mindful of. Now, the next topic that we have is Section 94B, which is limitation of interest deduction. Before limitation of interest deduction, just to give you a brief background, um, there is, debt and equity are, the instruments through which the company is generally financed or capital. The manner in which a company is capitalized has a major impact on the amount of taxable profit, as the tax laws of country, they generally provide for a deduction in respect of interest paid or payable for taxable profit computation. However, the dividend that you actually pay on equity contribution, that is not deductible. And this is the reason the higher the level of debt in a company and the amount of interest that it pays, the lower will be its taxable income. So what multinational groups they actually do, they are able to structure their financing arrangement and they maximize tax benefits through intra-group financing. In this manner, the MNEs are able to claim excessive deduction of interest in high tax jurisdiction and they shift the profit to low tax jurisdiction, which is basically called as BEPS. Now, this is the reason they came up with Section 94B, which is limitation of interest deduction. So this is the reason Section 94B has been inserted in the Income Tax Act in line with recommendations of OECD BEPS Action Plan 4. And they provide that interest expenses which are claimed by an entity on loan borrowed from its AE shall not be deductible in computation of income under PGBP to the extent it arises from excess interest. And then what is excess interest? Well, it's going to be total interest paid or payable in excess of 30% of EBITDA of the borrower in the previous year, or interest paid or payable to AE for that previous year, whichever is less. So if an Indian company, which is the borrower, it incurs any expenditure by way of its interest in respect of debt which it has issued to its non-resident AE, and such interest exceeds 1 crore rupees, then the interest which is paid or payable by such Indian company in excess of 30% of EBITDA, or the interest which is paid or payable to the AE, whichever is lower, it will not be allowed as deduction under Section 94B. So what I'm trying to say is that it will be applicable only where the expenditure on interest exceeds 1 crore rupees. Otherwise, this is not going to be applicable. So what we've done is I have provided this particular chart here. Just take a minute and read through this particular chart and then we'll discuss it further. Okay, so this is the chart that talks about limitation of interest deduction. Well, the first thing that you have to see is the borrower an Indian company or PE of a foreign company? If you say no, then this will not apply. But if you say yes, well, then the borrower, is it a bank or NBFC, notified NBFC? Well, if you say yes, then it will not apply. But then no, yes, is the lender a PE in India of a non-resident engaged in business of banking? Well, no. Well, then you have to see, is the interest exceeding 1 crore rupees? Well, yes. Well, then excess interest not allowed as deduction. What is the excess interest? Well, it will be interest paid or payable, or interest paid or payable in excess of 30% of EBITDA, whatever is lower. Now, the disallowed interest, it can be carried forward for 8 assessment years for deduction against PGBP to the extent of maximum allowable interest expense. So this is the entire thing on limitation of interest deduction. Now, the last topic that we have for today is advance rulings. Now, what is advance ruling? Well, advance ruling is more like, written opinions, or they are authoritative decisions. Sorry, advance rulings are more like written opinions, or these are more like authoritative decisions which are by an authority, which are empowered to render it with regard to the tax consequences of a transaction or proposed transaction or an assessment in regard thereto. There was a time that we used to have AAR, but now we have Board for Advance Ruling. There was an Authority of Advance Ruling before, but now we have Board for Advance Ruling. Now, one of the key differences between AAR and BAR is the constitution of BAR. BAR would constitute of members of the Income Tax Department, that is, officers who would be at least the rank of Chief Commissioner and above. A proceeding before or a pronouncement of advance ruling by bar would not be questioned, or it will not be invalid on the ground merely on the existence of any vacancy or defect in the constitution of the bar. Now, who can be an applicant of bar? Well, as far as bar is concerned, the applicant under section 245 N B is can be a non-resident. Well, this can be in relation to a transaction which has been undertaken or is proposed to be undertaken by him. It can also be a resident in respect of the tax liability of a non-resident arising out of a transaction which has been undertaken or is proposed to be undertaken by a resident applicant with such non-resident. And such determination shall include the determination of any question of law or fact specified in the application. Or it can be resident or class of category of person notified by the central government. For them, the tax liability of the resident applicant arising out of the transaction which has been undertaken or proposed to be undertaken by such applicant, and such determination shall include the determination of any question of law or fact which is specified in the application. The central government, they've notified a resident in relation to tax liability arising out of one or more transaction valuing INR 100 crore or more in total. Then it can be a resident, an issue relating to the computation of total income, which is pending before the income tax authority or appellate tribunal. A public sector undertaking, it has been notified by the central government. Or it could be a resident or non-resident in relation to an arrangement which is proposed to be undertaken by a person being a resident or non-resident, is an impermissible avoidance agreement as referred to in chapter 10A. So in other words, what we're really trying to say is that a resident assessee cannot pursue both the remedies. They cannot appeal or put in a revision before the income tax authority or the appellate authority, as well as the application for advance ruling to the bar, to the board of advance ruling in respect of an issue. They cannot pursue both these remedies, in India. Now, as far as application is concerned, it is, this is the application that has to be, provided. An applicant which is provided in section 245N, the amount of one or more transaction which is undertaken or proposed to be undertaken does not exceed 100 crore, then it's going to be, the fee is going to be 2 lakh rupees. If it exceeds 100 crore but does not exceed 300 crore, then the fee is going to be INR 5 lakh rupees. Or if it exceeds 300 crore, then the fee is going to be 10 lakh rupees. Any other applicant, for all the cases, the fee is going to be 10,000 rupees. So section 245Q, subsection 3, it provides that an applicant may withdraw an application within 30 days from the date of the application. So that is what it actually provides for. Now, what is the procedure for advance ruling? Well, the board shall not allow an application where the question which is raised in the application is one, pending before the income tax authorities or tribunal or court. Well, it is for the determination of fair market value or the transaction designed for avoidance of income tax. So if the transaction is already pending before any income tax authority or appellate tribunal or any court, well, then it is not going to allow the application. However, if the resident is following, like notified by the central government, they can seek, advance ruling, even if the question is pending before income tax authority or appellate tribunal. Then if it involves the determination of fair market value of any property, then advance ruling is not going to be allowed. Then, if the transaction relates to a transaction or issue which is designed prima facie for avoidance of income tax, well, then also it's not going to be allowed, except in case of resident which is following or which is notified by the central government for an impermissible, which is proposed to be undertaken if it is an impermissible avoidance arrangement. Now, the board has to pronounce the advance ruling within 6 months from the receipt of application by the board. So this is to be done within a matter of 6 months, within 6 months. Now, this is section 245T, which talks about advance ruling to be void. And then there is section 245W, which is appeal. Now, as per the amendment that has been provided, the order of bar would not be binding, and either of the aggrieved parties, it could be the taxpayer or the income tax department, they would have the liberty to file an appeal against the order of the bar, with the High Court. So this is what is provided in section 245W. Now, 245T says that where the Board of Advance Ruling finds on a representation made to it by the PCIT or the CIT or otherwise that an advance ruling which is pronounced has been obtained by the applicant by fraud or it is by misrepresentation of facts, well, the board may, by order, declare such ruling to be void ab initio if it is obtained by, fraud or misrepresentation. Now, appeal to the High Court by the applicant. The applicant who is aggrieved by any ruling which is pronounced or order which is passed by the bar or AO on the directions of the PCIT or CIT may appeal to the High Court against such ruling or order of bar. He has to do so within 60 days from the date of communication of that order or ruling in the prescribed form or manner. However, where the High Court is satisfied that on the application made by the appellant in this behalf, that the appellant was prevented by sufficient cause from presenting the appeal within 60 days period, as specified above, then it may grant further period of 30 days for filing such appeal. So what I'm really trying to say is that you get a period where you can make appeal to the High Court. And if advance ruling is taken with respect to fraud or misrepresentation, then it's going to be void ab initio. Now, these are the two questions that we will be discussing for the purposes of, bar. Now, these two questions appeared in past papers. This was for 3 marks. And just take a minute and read through these two questions, then we'll discuss it. Okay, so this particular, there are two questions right here. The first one is on Mr. Ricky, a resident individual, is aggrieved by an order passed by the board for advance ruling on 1st October 2021. Since the decision of the board is binding on the applicant, he has no further option but to accept the board for, the ruling of, the board. Now, is this statement correct or not? Well, this is not correct. Since the decision of the board is binding on the applicant, he has no option but to accept the ruling of the board. This is, incorrect, because now they can file an appeal to the High Court. So this is the amendment provision. The order of the bar would not be binding on, the taxpayer. They would have the liberty to file an appeal against the order of the bar with the High Court. The second thing is Messrs. A Limited, an Indian public sector company, wants to seek advance ruling from the Board of Advance Ruling in respect of a matter in relation to computation of its total income involving a question of law relating to such computation. However, the matter is already pending before the ITAT as on the date of application for advance ruling. That is 12th December 2021. It cannot seek the Board of Advance ruling till the matter is pending before the ITAT. Well, this is also wrong. Well, that is because generally, yes, this is the case, but there is an exception out here for Indian public sector companies. If it is notified, well, then this is where it was provided. If it is pending before the income tax authority, well, the board will not allow it. But a resident falling within the class of resident notified by the central government, even if it is, even if the question raised is pending before the income tax authority or appellate tribunal, then also they can, allow it. Where does it say that, the notified by central government? Well, it says it here. A public sector undertaking has been notified by the central government. So this is where this is the Indian public sector company. It has been notified by the central government. This is the reason they, even if the matter is pending before ITAT, they can seek Board of Advance ruling against this particular matter. So yes, these were, the two questions that we had. And with this, we finish with today's, session. This was the entire revisionary session where we covered all these topics relating to transfer pricing, and we covered these particular topics relating to advance, ruling. I am putting this code. I'm happy to connect, with you guys, and I can take questions, uh, you know, um, through the board, through the BOS. I can take questions. So thank you so much for today's session and all the very, very best. Thank you so much. Sir, session done. Happy to connect with you guys through this code and happy to take questions. Thank you so much for today's session. I hope you were able to understand the concepts that you're trying to explain. Thank you so much. Yes. Thank you. Good night.